Hello everybody, my name is Mark. Welcome to another video. And yesterday, I was going to do this video yesterday, but yesterday was get out and vote day. And so I did that, did not have time to do the video. So today I'm going to do the video, and this is what I did yesterday. I sold a put option on this stock right here, OVID. It's a pharmaceutical company, therapeutics. And one of the things that I like about selling puts, the way that I'm doing it anyways, is that there's so many stocks out there. I learn a lot. I never heard of this company before. It's a small cap stock. Let me go to my Ameritrade and let me put in OVID here. And it's a very almost a penny stock. It's got a $340 million market cap. And as I was looking at the chart, the company's been around 2 years. Looks like it goes back to about mid 2017, so maybe about 2.5 years. And this is their chart. They started high and then they went down, and this is the lowest that they've been, about $1.50, maybe $1.45. And every time they've been down, they've recovered. And so I found this stock on my trusty bar chart, which is this website right here. I'll get to that later in a minute. And so here's what I did. Let me go to my transaction and let me show you the wonderful put that I sold. So here it is right here. I sold one put. It expires in 2 weeks, November 20th, and strike price $2.50, and I took in $24. And already today, the put option is down a little bit. These are my positions right here, and you can see here's my put right there, and already it's dropped down to $17. So if I wanted to, I could close it out today and made like $6 or $7. But I'm choosing to hold it till the bitter end, and I'm going to hold it till expiration, or unless it takes a big drop tomorrow and it goes down to $10, then I'll take the quick profit. And if I make $10 or $15, that will recover the small loss that I took on Hertz the other day when I lost $10 because Hertz went down into the pink sheets. Now, the numbers, the delta, let me look up the delta on OVID so that you know that the numbers were sort of in my favor. So let's go to the option chain and let's go to the Greek like this. And now let's go. Okay, so let's go to the put, and the delta yesterday, it's actually dropped. So that even puts it even more in my favor. But yesterday, the delta was at about 0.1. So 0.1 times 250, or I'm sorry, 0.1 times 100 is 10. So 10 times the $24 or whatever would have gave me $240. And then I take the loss, which is 250 minus 24. So about $225 loss. So I'm about $20 in the green on this delta number. So that put the numbers in my favor. And so I was looking at the chart and I said, what the heck? The chart looks strong enough for the risk that I'm taking. Now, here's what I want to get to. I like to try to make points and lessons and information as I'm simultaneously trading my options. And I like to kind of share a little bit the way I think about trading options. So there are two things that you can do when you are trading options. You can go for home runs or you can go for the batting average. Now, when I'm selling puts, and let me go, now I'll go to the bar chart here, okay? The way that I find my puts, I like to try to look at the high implied volatilities, okay? And so you see IV here. This is today. Today is the 4th of November, and all of these, you see 477%. These are super high implied volatility. And so I like to look for put options like these. Most of these are going to be small cappers or penny stocks. And I didn't even have time to look through these today. And frankly, because I overslept. That happens sometimes. Sometimes I'm just too tired to trade my options. But when I get a chance, I do this every single day, maybe about 15 minutes a day. I'll look through this and then I'll go to the chart. look up the chart, make sure the chart looks okay, make sure the company's been around, it's strong, and then I'll look at the options, etc., and then I'll make a decision if the numbers are in my favor, and I'll always put in that delta. I'll always calculate that ratio and make sure that the numbers are in my favor, because to me, the real mathematical edge is in numbers. It's not in chart patterns. I don't really believe in chart patterns that they give you an edge. I also don't believe in candlestick patterns. I know that there's tons of videos on candlestick patterns, and maybe, to be honest, I just don't know how to do all that stuff, and so I'm kind of being flippant about it. But to me, options is what I know, and I know that the Greeks are pure math, okay, and numbers don't lie, okay. When you're looking at a chart here, okay, you're looking at the buyers and the sellers when they choose to buy and sell. And how can you expect me to believe, or how can you convince me that because you got all these red candles here, I should go short, and then I go short here, and then boom, it goes up, right? And then I go long, and then boom, it goes down. So all of the day traders will tell you, well, you got to have an edge, and you got to look for certain patterns. And I don't know all those nitty-gritty stuff, but I do know options, I do know Greeks. Okay. And when you're trading options, okay, there are two things that you got to think about, there are two ways that you can go about it. You can go for a home run, or you can go for batting average. And like I said, to me, I'm doing the batting average way, which means that it's a numbers game. When you sell puts, you're never going to get a lot of money selling a put. And if we go through just these stocks today, okay, these options here, and we look at the puts, okay, here's one, the $2 strike price, the bid is 30, the ask is 35. Now, that's not a lot of money, is it? That's the most money that you can make, is $30 or $35 if you get the ask. And this is a $3 put. Here you can get $70 or you can get $75. Now, you're risking $300 to do it. On this one, you're risking $200. Now, if you were to make $75 on a $300 risk, then that'd be a very good return. That'd be almost 25% return, something like that. So that would be very good, right? So the return is good, but you're not going to get the home runs. If you want to get the home runs, you got to be buying these options. For example, let's say that you bought this $2 put. It would cost you a whopping $32. We'll go by the midpoint. So you're spending $32. Let's say that the stock drops down to $1. Now you can make $100, right? That's more money than the $30 you can make, or even better. Let's say you're to buy one of these calls. Here's one, BCLI. That's one that I'm selling puts on. But let's say that you are going for the home runs and you want to buy a call. So the strike is 25. The bid is 235. The ask, the midpoint, we'll go by the midpoint, 248. So it's going to cost you $248 to buy this $25 call. BCLI is only at $10.57. So in order to make money, this thing has to go above $25 plus the premium. So 25 plus 248 is $27.48. But what if it went to $50? You'd make a couple $1,000. That's what I call a home run. But obviously, it's a very low probability trade, right? What are the chances that this thing's going to go up that high by December the 18th of 2020? That's the expiration date. Low probability, but if you're right, you could hit a home run. You could knock it out of the park. Now, when you're selling to open puts, like what I'm doing, okay, and if we go to my transaction, the best thing that could happen to me is I could make $24.34. I'm not going to make $24.35. I'm not going to make $25. That's the most money that I can make. But that money that I'm going to make is on a $2.50 strike price. So $250, that's about a 10% return. In the expiration date is November the 20th. So in about 2 weeks and some change, I could make 10% return. So over the long run, I think this is a very profitable strategy, and I have a mathematical edge. I don't have much of a chart pattern edge. I'm not a day trader, but the math is in my favor. And so by simply playing the numbers game, looking for these options, sorry, I went to the wrong chart here, looking at lots of options here, all of them are paying good implied volatility. It means you're going to make a lot of money on that trade, and by playing the numbers game. I'm playing the batting average game. If you want to play the home run game, go ahead and do it. Look at these options. And actually, I probably wouldn't be looking at high implied volatility. I'd be looking at low implied volatility. If you're buying options, you want low implied volatility. If you're selling options, then you want to do high implied volatility. So those are the two ways that you can go about trading options. Is you can go for home runs, or you can go for batting averages. And if you're going for batting averages, then find a website that tells you, hey, this put option is paying really good premium, and then go ahead and sell it. And I think, in my opinion, I'm not a financial advisor, I'm not a pro, but I've done pretty okay at this. I'm not like hitting home runs, not knocking it out of the park, not going to hit $1 million home runs here, but it is a profitable strategy in the long run. And I'll close my video with this. The reason I'm doing this is because I don't know what's going to happen after the election. I want to see what's going to happen as far as the policies, and are we going to shut the government down, or I'm sorry, are we going to shut the country down, or are we going to open things back up? That will tell me if I should keep doing this, or if I should become bearish, I should get back into my diagonal spread. So this here is kind of a waiting strategy. It's a high probability, low risk, but decent return. I mean, I expect to make at least a few percent return on my money. I expect to make over the long run. Like, if I were to do this strategy for another year, I would expect to make maybe 5% return on my portfolio. So that's it for this video. So what are you going to do? Are you going to go for batting average, or are you going to go for home runs? Feel free to leave a comment. I will see you in the next video. Thank you for watching, and have a good day. Ciao.